Good afternoon, everybody, and welcome to our latest quarterly tax update. The topics for this particular update will focus firstly on the autumn statement, giving a bit of an overview on that. But as probably many of you are aware, there wasn't a huge amount in the autumn statement, so as well as covering off the key points following on from the announcement, we will also just pick up on some topical tax matters as we normally do, and hopefully there'll be something of interest to you. As usual, we've got the three speakers today. Myself, I'll be doing an update on business tax very shortly. Then I'll hand over to Vicky Hughes, who's Director of our Private Client Services, who will talk through private client matters. And finally, we'll have Paul, our Tax Resolution Director, who will cover off the various matters in the autumn statement around tax disputes and resolution, and also pick up on a couple of topical things that are in the headlines there as well. Usual format in that we'll be about 45 minutes. Please ask questions as you go along. If we have time, we'll pick them up as we go along. Otherwise, we can pick them up at the end using the Q&A button on Zoom to do that. That'll be grand. Right. So let's start off with business tax. So as far as the autumn statement was concerned, one of the main headlines on corporation tax was the concept of full expensing being made permanent. Now, full expensing as a concept was announced in the March budget, and initially it was only going to be in place for 3 years. But now it's announced that it will be put in on a permanent basis. Of course, it's only as permanent as much as a future government might decide to reverse that. But from commentary around this particular aspect, there doesn't seem to be any intention to row back on it. Now, of course, this was announced as one of the largest corporation tax breaks that have been announced in recent history. Of course, countering to that, we do have to remember that the main rate of corporation tax went up from 19 to 25% not so long ago. So relying on us having short memories there. But nevertheless, the fact that full expensing is now permanent does mean that we've got some certainty around the position. On R&D, there's a merger of the SME and RDEC schemes from April 2024. I'll talk a little bit in a little while just on some of the issues around that. This had been consulted on again for a few months now. We knew this was coming. We've now got confirmation of it, and we now know what the actual merge scheme is going to look like. Also on business tax, we had the announcement that the cash basis for unincorporated businesses was going to have the ceiling removed in terms of the turnover limit for when you can use the cash basis. And what it means is that for the qualifying businesses, so remember this is an unincorporated business, so it's not companies or LLPs, it's not LLPs with corporate members, for example, or partnerships with corporate members. So from 6th of April 2024, the turnover limit of £150,000 is now removed. And what it means, in essence, is that the cash basis is now the default basis for preparing accounts for those types of businesses. Now, you can still elect into the accruals basis if you want to, but in the absence of an election, the cash basis will be the default basis. As part of this change, it was also announced that the interest deduction restriction, which was always a bit of an anomaly for the cash basis, was £500. That's also going to be removed from the 6th of April. I think what was equally of interest in the autumn statement was around what wasn't announced compared with what was announced. As often happens with these fiscal events, there is often a lot of kite flying, as the phrase goes, beforehand to see how different proposals went down. There's certainly a lot of chatter around IHT, either changing the rates or going from the extreme of abolishing it altogether through to changing the rates or increasing the nil rate band. In the end, no announcements at all on IHT changes. Similarly for CGT, again, no changes there in terms of rates. There has been some talk around maybe aligning the CGT and income tax rates, or at least making them closer. But again, nothing on that. What did become apparent from the OBR forecasts that came out of the autumn statement was the impact of this concept of fiscal drag. So this is where people are being dragged into higher rate tax bands just through a function of higher inflation, which has led to higher wages, and the bands for the basic rate tax moving to higher rate and higher rate moving to additional rate, they've stayed exactly the same. And so as wages have increased, more people have been dragged into higher rates of tax, which of course has increased the tax burden. So notwithstanding the reduction in NIC, which Vicky will come on to shortly, overall the tax burden is still quite significant. There are no announcements around stamp duty land tax or stamp duty. And likewise, no announcements around the VAT threshold in terms of registration limits. Again, there's been a bit of chatter around whether that should be increased or decreased, depending on what view you had. But as with the other matters above, silence on that point. And finally, nothing around cliff edge reforms. And what I mean by that is that at certain levels of income, the marginal rate of tax can be in 60, sometimes 70 odd %. So for example, if you're over £50,000, that's when the high income child benefit charge starts to come into play. Over £100,000, you start to get the personal allowance eroded. And so income in those bands immediately above those amounts, for each pound that you earn, the marginal rate is far more than 40%, because of the way those reliefs are clawed back. But again, nothing mentioned in terms of trying to alleviate those anomalies that have arisen through those particular policy decisions historically. So looking at the R&D changes in particular. So the merging of the two schemes comes into place for accounting periods commencing on or after the 1st of April 2024. Now, when the consultation was first announced for these for this merged scheme, one of the potential routes was for it to apply to expenditure occurring after the 1st of April 2024. But it's confirmed it's accounting periods commencing after 1st of April 2024. So what it means, in principle, is that we should have a single R&D scheme. Well, that's sort of what we've got, and I'll come on to shortly as to why that's not entirely going to be the case, and there will still be some complications. Now, the way the new merged scheme will work is going to be based on the RDEC. So this is the large company scheme. And this works in a very different way to the SME scheme, whereby with the SME scheme, the way that works is you have your qualifying R&D expenditure, and you get an additional tax deduction for 130% of that expenditure. With the RDEC scheme, you get a credit for your qualifying R&D expenditure, that credit is taxable, and then you get relief for that credit in the tax computation. So the effective relief is calculated in a different way and is quite a way less than the SME relief in terms of the effective benefit coming out of it. So for SMEs, there will be less benefit from this new merge scheme going forward. For profitable companies, the effective relief is 15% of the R&D expenditure. Now, for loss-making companies, there is still the ability to have a repayable tax credit in lieu of those losses. But again, the way this works for the RDEC scheme is different to the SME scheme. With the RDEC scheme, you'll get a credit for, you'll get a repayable credit for the amount you can't set off against your tax liability. However, 19% of that credit is withheld, and you only get the benefit of that if there are taxable profits in the future, or if there's a tax liability in the future to set that off against. So again, works in a different way to the SME repayable credit in terms of how that works at the moment. I mentioned the first bullet point that whilst we do have this merge scheme from the 1st of April, the SME scheme is still going to continue, but it's only going to apply to what they've called R&D intensive companies. And very broadly, this is where more than 30% of the qualifying expenses of a company relate to R&D. So with those types of companies, the SME scheme will still apply and will still work in the way it works at the moment. Finally, on R&D, I just wanted to mention the additional information form, which has been in place now since the 7th of August of this year. And this additional information form is required for all R&D claims which are now submitted. So it doesn't matter whether they're SME, whether they're RDEC, whether it's a repayable credit, whether it's just set off against profits, against your liability. Any R&D claim that goes in has to have this additional information form submitted before the CT600 is submitted. So you still submit the CT600 and the tax computation with the R&D claim in there, as you would do now. And we'd also recommend you still submit an R&D report with that CT600 and computation. However, before that is submitted, you need to go through this process of the additional information form. It's through a separate portal on HMRC's website. And it draws in a lot of information which you will probably have in the R&D report anyway, but there's also additional information that's required to be reported in that form as well. HMRC did release some statistics recently which said that that 50% of R&D claims which were submitted were rejected because the additional information form hadn't been submitted prior to the CT600 going in. So there is some non-compliance around this. And in essence, what actually happens is that if you submit an R&D claim without submitting the additional information form, the revenue just don't process the R&D claim element in the CT600. So they will process the computation as if no R&D claim had been made. So it's important that that form is now dealt with, like I say, prior to submission of the CT600. Now, moving on from the autumn statement, I did think it was worthwhile spending a few minutes talking about associated companies, because we are now very much into the new regime, or the old regime revisited, whereby from the 1st of April 2023, for accounting periods thereafter, or periods spanning that, we do need to consider the number of associated companies a company has both in terms of looking at the corporation tax rate, which we need to apply to the profits made in the period, and also when we're looking at whether a company might fall within the quarterly instalment payment regime as well. And this has all come about because of the main rate of corporation tax going up to 25%. We've retained the small companies rate at 19%. And then we've got this marginal band between 50,000 of profits and 250,000 of profits. And it's that 50 and 250 which needs to be prorated by the number of associated companies, as you'll probably be aware. So what are we talking about with associated companies? Well, we're looking at companies under common control. And for the purpose of calculating the rate at which a company pays corporation tax, every company that was associated at any time during the relevant accounting period has to be included. Therefore, being associated with just one day in the relevant period will count. However, you don't need to include dormant companies from that calculation. So a company is associated with another company if one of them has control of the other, or they are both under the control of the same person or persons. And we're using the definition of control here for these purposes in the Corporation Tax Act. And so it's where a person is exercises or is able to exercise or is entitled to acquire direct or indirect control over the company's affairs. And in particular, it applies where a person is entitled to acquire the greater part of the share capital, voting power, distributable income, or net assets and the winding up. So it's not necessarily just as straightforward as looking at the share capital and how that splits. There could be a shareholders agreement which needs to be taken into account. Any different classes of shares which might have different rights, that could impact the situation as well. And we also, in certain circumstances, have to consider shares held by a person's associates. Now, this applies if there is what's called substantial commercial interdependence between the two companies. So if the two companies are linked in some way, then not only do you look at the individual themselves in terms of whether they have common control, you also look at the associates of that individual as well. I'll come on to now just talk about those sort of terms in a bit more detail. So the people who are considered to be associates are relatives. And here we're looking at spouse, civil partner, parents, remote forebear, children's brothers and sisters. Business partners, trustees of settlements created by them, trustees settlements created by a relative, trustees and PRs or any settlements for holding shares in which they have an interest. And relatives, that generally includes, we're looking at direct family relationships, and so we don't include things like aunts, uncles, cousins, nephews, nieces. Now, I mentioned we only have to be concerned about the rights of associates if we have substantial commercial interdependence. And there's one of three types of linkage here, which could mean two companies do have this substantial commercial interdependence. One is financial interdependence, and this reflects the extent which one company gives financial support directly or indirectly to another. There's an economic interdependence. So two companies will be economically independent if they seek to realize the same economic objective, or the activities of one benefit the other, or they have common customers. And finally, there's organizational interdependence. And this is where businesses have common management or employees, common premises, or common equipment. What the revenue do say is the attribution of rights held by associates, it's not intended to apply where there's an accidental circumstance, but where there is a real interdependence between the parties. Just finally, on the point around associated companies, just want to talk about this concept of minimum controlling shareholding. So when we're looking at whether companies are under common control, this is the process we have to go through. So it's the minimum combination of persons who control one company must be exactly the same as that minimum combination who control another company. And you bring in associates as appropriate if there is substantial commercial interdependence between those two companies. So two companies would only be treated as associated with each other if it's the same minimum controlling combination. I'll just run through a quick example now, just give you a feel as to how that works in practice. So we have X Limited and Y Limited here. So with X Limited, that could be controlled by A and B, A and C, or B and C. Y Limited, that could be controlled by A and B, A and D, A and E, or B and D and E. Now, X and Y Limited there are associated because there is a minimum controlling combination there, being A and B, who control both companies. And finally, I just wanted to touch on quarterly installment payments, because again, this is something that's been impacted by the associated companies rules being brought back in. So quarterly installments apply where profits, as defined, are more than 1.5 million. Now, for accounting periods beginning on or after the 1st of April 2023, that 1.5 million is prorated based on the number of associated companies, not the number of group companies as it was previously. The other limits I've mentioned there are 10 million and 20 million. The 20 million applies for what are called very large companies. So they still pay tax by quarterly installments. It's just that the payment dates are accelerated. Now, those profit limits are based on what are called augmented profits, which will usually be the taxable profits, but it also includes dividends from non-group companies. So whilst those dividends invariably won't be taxable, because dividends received by companies generally aren't taxable, if they are received from non-group companies, i.e. where you own less than 51%, then those dividends are included when you're looking at the 1.5 million profit figure. So a bit of care around investment companies that might have a diverse portfolio of investments. Now, when assessing the number of associated companies for quarterly installment payment purposes, we look at the number of associated stroke group companies at the start of the accounting period and divide the limits accordingly. The way the legislation is worded is that it's on the last day of the previous accounting period. That's when you look at the number of associated companies. Now, remember, there is a grace period here if the company wasn't large in the previous year, but would be large in the current year. So generally speaking, you have to be large for 2 consecutive years, and it's only in that second year that quarterly installment payments will apply. However, 2 exceptions to that: very large companies, i.e. where your profits are more than 20 million, prorated by the number of associated companies, they fall into the quarterly installment payment regime straight away. No grace period for very large companies. And you'll see there, you actually pay all of the liability in year months 2, 5, 8, and 11. Whereas for your normal quarterly installment payments, it's months 7 and 10 of the current year and 1 and 4 of the following year when the payment is made. There's also no grace period if the taxable profits or the augmented profits are more than £10 million. So the payment dates will still follow the large company payment dates, but if the profits are more than £10 million prorated for the number of associated companies, you don't have a grace period for quarterly installment payment purposes. That's all I wanted to talk about as far as business tax is concerned. I'll now hand you over to Vicky, who will cover off private client tax matters. Thank you.
Thank you, Craig, and good afternoon, everybody. I'm going to cover off some of the key measures that came out of the autumn statement that impact individuals, and also catch up on some previous announcements. So first of all, turning to national insurance. This was an area that was sort of part of the main headlines in the autumn statement. So from the 6th of January, so unusually sort of partway through the tax year, the main rate of employee Class 1 national insurance contributions will reduce by 2%. So it's going down from 12% to 10%. Now, the combined 30% tax and NIC rate for basic rate employees is said to be the lowest rate since the 1980s. So that was a main headline coming out of the autumn statement. Then from the 6th of April 2024, they're also making other changes. So Class 4 national insurance on business profits is reducing from 9% to 8%, which is a saving of up to £377 next tax year. And the compulsory Class 2 national insurance, which is a flat rate of £3.45 per week, is actually being abolished. And the Class 3 national insurance rates are frozen. But there have been no changes for businesses. So businesses with employees have no cut in the employer national insurance contribution rate. So that remains at 13.8%. So then there were some major announcements to do with the simplification of Making Tax Digital. And as a reminder, because Making Tax Digital has been trailed for quite a long time, from April 2026, it will impact the self-employed and or individuals with property income over 50,000. And from April 2027, it will impact the self-employed and or those with property income over the 30,000 threshold. Now, the announcements are very welcome because they simplify the requirements for all taxpayers to provide quarterly updates and also simplify matters for taxpayers with more complex affairs. And by that, we're sort of talking about landlords with jointly owned property. It's been confirmed that the quarterly updates will now work on a cumulative basis rather than a standalone basis with a requirement to correct the previous quarter's return if it was wrong. So that means it should be simpler to submit corrections as part of the next update, provided those updates fall within the same tax year. It's also removed the requirement to provide an end of period statement, so reducing it to 4 disclosures rather than 5. It clarifies that some taxpayers will be exempt, and that would include those individuals who have no national insurance number. It also enables taxpayers to be represented by more than one tax agent. So, for example, you could have different agents doing the quarterly updates to the tax return. And it's also been announced that the government will keep under review the plan to further extend this system to businesses and landlords with income below the 30,000 thresholds. It's also said that landlords would be able to choose not to submit quarterly updates of expenses and to keep less detailed digital records where they have jointly owned property. And in the longer term, it's expected that partnerships will be included, but as yet, there's no start date for that to happen. And finally, there was discussion that participants who agreed to take part in the pilot, so go into this system early, they will benefit from a more lenient penalty regime going forwards. So they were all welcome announcements in those areas. So then moving on to pensions. Now, this is a follow-up to comments that I made in our previous tax update in September. And it's been confirmed that the lifetime allowance will be abolished with effect from the 6th of April, which is something that had been said in the spring. There has also been some welcome clarification because there was uncertainty about what would happen to the pensions relating to those individuals who died under the age of 75. And thankfully, it's been confirmed that the existing tax exemptions in the event of a registered pension scheme member dying before they've reached 75 will continue. So that maintains the current treatment and means that if somebody died under the age of 75, there is a sort of a tax-free possibility of accessing their pension by their beneficiaries. There were also other announcements, and effectively they announced changes to facilitate the consolidation of pension funds and pension pots and to give greater control over those two individuals. Now, there was also discussion about when individuals will have to submit tax returns, and this is a further reduction or a further change, sorry, in the thresholds and the rules surrounding when individuals must submit tax returns. So it's been announced that from the 6th of April 2024, individuals with an income of more than 150,000, which is taxed through PAYE, will not be required to submit self-assessment returns unless they have another reason to do so. And it's been estimated that that could mean that up to 338,000 individuals would no longer have to submit a tax return. Now, at first glance, that would sound like a positive effect, and that individuals obviously have less onerous obligations to meet. But it really isn't as straightforward as it sounds, and there really is potential for HMRC penalties or overpayment of tax to arise, because the situation is very complicated. For example, individuals earning more than £100,000 may have complicated tax affairs, even if their main source of income is taxed under the PAYE system, so it's deducted at source. For example, additional rate taxpayers are not entitled to the personal savings allowance, and so even receiving a relatively small amount of bank interest would result in an income tax liability. And higher rate taxpayers only have a £500 savings interest-free allowance. Now, with the way that interest rates have been and currently are, it doesn't take a high level of savings outside an ISA to be over those thresholds and be in a tax payment position with the revenue. Also, if individuals are making contributions into personal pensions or making gift aid payments, if they didn't claim relief, then they would be overpaying tax. Also, filing returns annually, make sure that you're ensuring the correct amount of tax is paid and the tapered effect of the tax-free allowance is taken into account, because otherwise you could end up overpaying tax or underpaying tax and having serious ramifications with the revenue. So moving on to other things here, just mentioning that as well as interest, also if individuals have dividend income outside of the ISA wrapper, they could also have taxes to pay to the revenue, which they could inadvertently forget to declare and forget that they need to pay tax on. So as a reminder, from the 6th of April 2024, a taxpayer would have tax to pay if the dividend income is more than £500. If you're an employee earning more than the personal allowance. Now, it is possible to get the amount of tax correct without submitting a tax return, but that means that you have to make sure your tax codes are correct, and that requires interaction with the revenue, which is not always straightforward. Adjustments can be made to PAYE codes to do with savings and investment income, pension contributions, and charitable giving, but it can be time consuming and hard to keep track of these and whether they're correct. Indeed, it does seem that still submitting tax returns would give a taxpayer peace of mind and remind them to get their tax affairs in order. And it does make you wonder whether this increase in the threshold has been introduced as a cost-saving measure without consideration of the wider impact on taxpayers. So I thought it would just be useful to point out those individuals that would have to do tax returns still. So as a reminder, you should be doing tax returns if you have self-employed income and the gross income from that's over £1,000. You're a partner in a business partnership. You have a liability to the high income child benefit charge, although there has been some announcements that in due course that process will be simplified and taken out of the tax return system. And if you're in receipt of untaxed income, like we've mentioned, for example, the dividends or savings interest, and also importantly, property rental income would not bring you within those rules of not having to do a tax return. So moving on to other changes that were mentioned in the autumn statement, the government has said that they'll make changes to ISAs which are designed to simplify and widen the scope of the investments which can be included. And they've also mentioned that they'll be moving on to a digital system that should make it more straightforward to have ISAs. It's also been welcomed that, as expected, it's been confirmed that there's an extension to the Enterprise Investment Scheme and the Venture Capital Trust Scheme, and that that's going to be extended to 2035 to ensure that growth capital continues to be available to early stage innovative companies. And linked to that are the various tax reliefs that individuals can get for investing in these more risky companies. And there's also included in there that legislation will be introduced to address the potential overcollection of tax and national insurance contributions where there's been non-compliance within the IR35 rules, because you can be in a disadvantageous position here if you are not complying with the rules correctly. So that should take out the double taxation that can arise in some situations. And then, as a reminder of previous announcements that we're aware of and do come into effect on the 6th of April. As a reminder, the dividend allowance reduces from the £1,000 that it is this current tax year to £500. The capital gains tax annual exemption is reducing from £6,000 to £3,000 per individual, which as a result means that the maximum is £1,500 for trusts, although that gets reduced if the settlor set up more than one trust, and the minimum level per trust would be £600. Now, those thresholds are obviously very low compared to the 12,300 that we've been used to in the 22-23 tax return that we're in the process of completing for clients at the moment. So it does mean that individuals have to monitor more closely if they're going to have capital gains tax to pay. And it does mean that the likelihood of individuals falling within the 60-day reporting requirements for disposals of residential property could be a serious risk that needs monitoring, where you've got individuals that have properties that don't qualify for principal private residence relief, for example. There's also some simplification of the taxation of trusts and estates and when various forms are needing to be submitted. And we did discuss that in more detail in the previous professional tax update a few months ago. And likewise, within those slides in that presentation, we did talk about the fact that there are wide changes to agricultural property relief and woodlands relief for inheritance tax, which restricts the territorial scope following Brexit and means that only UK located assets will be qualifying under those inheritance tax reliefs going forward. And similarly, there are restrictions of charitable reliefs to UK charities and community amateur sports clubs going forwards. So it might not affect everybody, but these are important changes if it applies to you or your clients. Now, as you can see, there are a variety of changes there, and so there were some interesting things that came out of the autumn statement. I'll now pass you on to Paul, who's going to take you through some areas of his expertise.
Thank you, Vicky. Good afternoon, everybody. In the field of tax investigations, tax dispute resolution, HMRC compliance activity, in the autumn statement, there was only one particular item within this area that was referred to. And this was what they call collecting the tax debt. And the announcement was that HMRC, in addition to the funding that has in the last few years been put in to increase the activity in tackling the debt, which is increasingly lodged now and difficult for HMRC to collect, they are going to be given a further £163 million in this area. Not least because, as at 30th of September, just a couple of months ago, the liability that HMRC are owed now stands at £45.5 billion in unpaid taxes. And these are taxes that are not necessarily in dispute. They are just, from HMRC's perspective, uncollected, still owing. And what they're trying to do is to give their debt management and banking unit an increase in its capacity, not least because what they are looking to distinguish is those taxpayers, particularly individuals and businesses, who temporarily are unable to pay, otherwise would like to settle their debt, and thereby, from HMRC's perspective, need some support, as opposed to those who can pay or could pay, but don't, or choose not to do so for whatever reason. what HMRC are going to do as part of this increased activity in trying to collect this amount of money owing to them is to, I mean, I think we're all familiar with what's known as a time to pay arrangement, but they're now going to set up what they call a self-service time to pay arrangement. And that will relate to the areas of self-assessment tax, pay-as-you-earn, or VAT. And the purpose behind this is to enable the taxpayer or their agents or advisors to request an instalment payment arrangement more readily than ordinarily would be the case. They can do this now, or will be able to do it now, online. And the purpose behind this is to encourage those businesses to actually take the initiative and contact HMRC either via the SSTTP as it's known, or even just by ringing Debt Management and Banking. Now, in the past, for those of us that have taken a time to pay requests on behalf of clients, HMRC, in my experience, are quite cooperative and understanding. And what the hope here is that this can be taken a step further from HMRC's perspective, and they will have more people coming forward to request time to pay arrangements than would previously perhaps have been the case. And the point of this is that there will more likely be a favourable arrangement from the taxpayer's perspective, the client's perspective, by going this route rather than sitting on their hands and waiting for the debt collection teams, which may include third-party debt collection agencies. And when they're involved, they have no knowledge of the case. Their brief is just to try and collect the tax as quickly as they can. So the purpose behind all this is to encourage a proactive contact with HMRC. We have to bear in mind that the longer and longer this tax is outstanding, the current interest rate running on late payment of tax is now standing at 7.75%. So the rate of interest on the late payment is itself an accumulation which needs to be factored into the arrangements. But the purpose behind all this is to encourage people to come forward. And this is part of what I referred to in the previous session about what's known as the tax gap. This is another element of package of measures designed to try and reduce the amount owing to HMRC. And it is said that this phase of activity will raise significant amounts of money, £5 billion over the next 5 years. There is still a lot more for HMRC to go at, but it's a further step in the way they see it in trying to reduce the arrears of tax. This was a topic that was announced a month or so ago. It wasn't in the autumn statement, but it was. The point here is that HMRC receive a lot of information via annual returns, and Companies House, and this perhaps isn't rocket science in one sense, but what's going to happen here is that a pilot scheme is to be undertaken between the two agencies and that units, HMRC and Companies House. And the purpose behind this is to identify more readily differences in tax returns that are filed with HMRC and with accounts that are filed at the Companies House. Now, you'll be aware that HMRC, in a typical company situation, will receive the CT 600 and they'll receive the accounts in IXBRL format. And what they're seeking to do here is to identify, if possible, from their own perspective, an area in a company or companies where, on the face of it at least, there are understatements of profits and income or gains, and thereby consequently a reduction in the liabilities that would otherwise be due to HMRC. And I think also, although it didn't say so in the announcement, that this is probably with one eye to Companies House now going to require very soon additional information being filed for small companies where, for example, a number of companies only file a balance sheet and abbreviated or abridged accounts, whereas going forward, Companies House will require some form of a profit and loss account. And I think that the two are going to be allied in this regard. And so we will see going forward, but it's something for practitioners to be mindful of. And the point of this is that the likelihood is it will start to raise more inquiries, because if there is a suspicion of any fraud or tax avoidance that HMRC do not find acceptable, they will thereby raise more inquiries, and we have to anticipate that this will happen going forward. So it's something that we need to be mindful of as practitioners and talk to clients about. This particular topic I wanted to spend a few moments on, because I suspect that as practitioners you will have perhaps one to several clients maybe who are what HMRC banner as individual property landlords. These are individuals now owning rental properties. And there has been for a little while out in the marketplace an avoidance arrangement, which HMRC is a tax avoidance scheme that's been quite heavily marketed. And HMRC have referred to this now as what they call their hybrid business model. And up until recently, they haven't paid particular regard to it, but it's got to the point now where, because of the amounts involved here and the numbers of cases that are being made aware to HMRC, that HMRC have issued what they do from time to time, one of their spotlights, as they call them, Spotlight 63. Spotlights are issued by HMRC typically when HMRC have an issue that they want to profile HMRC's resistance to, typically tax avoidance schemes, tax arrangements that they do not find acceptable. They will highlight them in what they call a spotlight. And Spotlight 63, which is available on the HMRC website, for example, if you wanted to refer to it in more detail, is specifically addressing this particular hybrid business model that's out in the marketplace. And it's quite wide-ranging, and I thought it was well worth us spending just a few moments on it. Because of its nature, it is designed, it's one of these where it's almost too good to be true. But the promoters of these arrangements say that it will, as regards if the client has a mortgage on the property or properties and is thereby incurring loan interest charges, that the recent tax restrictions for higher rate taxpayers wouldn't typically apply in this case. It will reduce the amount of tax payable on the profits generated by the property. It does sound too good to be true, doesn't it? It will reduce the capital gains tax when the properties are sold, and it will reduce inheritance tax payable in respect of when the properties are otherwise brought into charge for inheritance tax purposes. So you can see why on the face of it, this will be very attractive to landlords who are looking out there in the market, online, to see is there a way that they can reduce their tax liability that their ongoing advisor might not have talked to them about or raised with them. And the arrangements are designed to use an LLP, a limited liability partnership, alongside a limited company. And what happens is that the individual landlord transfers the property or properties. It's normally more than one property. We're talking properties in the plural here, to the limited liability partnership. And then the members of the limited liability partnership can allocate those profits between themselves because they have the discretion to do so the way these arrangements are drawn up, so that consequently the individual members of the LLP remain as basic rate taxpayers, and the other profit, the greater part normally, would be allocated to the corporate member of the limited liability partnership. And then the corporate member claims a deduction for finance costs relating to the properties, which avoids the restriction that we referred to a moment ago. So the landlords are told, so this is why it is so attractive on the face of it to property landlords. They're told that the arrangements result in a lower tax bill. There are no upfront costs incurred in contributing the properties. and there's an uplift in base cost for CGT purposes. And the landlords remain basic rate taxpayers, so the finance cost restrictions don't apply. And so it goes on. The corporate member claims a full deduction for the share. And the corporate member is subject to corporation tax on the profit instead of the higher or additional rates of income tax that would apply. And as regards inheritance tax, business property relief, BPR, may be claimed in respect of the structure because it is said that it's carrying on a property rental business emphasis, resulting in full relief for inheritance tax in the event of the death of the landlord. Except for, if you read the tax technical press, and there have been 2 lengthy articles on this very topic in the last month or so, very well written articles, and they pull that whole structure to pieces basically. Even before, if you look at it from HMRC's point of view, they say that these structures transgress such legislation that anti-avoidance applies in a number of the elements of the structure, the way these things are put together. And not surprisingly, what HMRC are encouraging participants to do is to withdraw from the scheme and settle up with HMRC at the earliest opportunity. And HMRC are sufficiently serious about this that they've set up an email address specifically for this particular item, spotlight63@hmrc.gov.uk. And the reason they've done that is that it is said that there are already hundreds of landlords who have used this scheme. And it's estimated that in tax cost terms to HMRC, it's standing at around the £50 million mark. But not only is it a flawed scheme, and this is the purpose why I wanted to raise this with you as practitioners, because you may well have, as I've mentioned, 1 or 2 clients at least who were sufficiently attracted by this. But it's also at risk of breaching the terms of the mortgage, assuming that there is a mortgage on the property, because such a transfer of the property to the LLP, for example, in the structure, is a transfer that would be notifiable to the mortgage lender and would almost certainly result in a breach of the mortgage terms and conditions. As opposed to sitting waiting for HMRC to get in touch, particularly as regards Spotlight 63 structures, I just thought it was helpful as a reminder, talking about properties held by individual clients for rental purposes, that if for whatever reason the income from those properties, or indeed the gains if properties have been disposed of, if either or both of those haven't been disclosed on tax returns, that whilst a number of disclosure facilities that HMRC have made available over the years have come and gone, there is one that still remains, and this is HMRC's Let Property campaign. And this is addressed to encourage individual landlords letting out residential property, previously undisclosed taxes on the rental income, to come forward now, irrespective of where those properties may reside, and settle on the best possible terms with HMRC. What that means is that the penalty rates will be lower by coming forward and settling with HMRC, rather than waiting for HMRC to raise an inquiry in the first place, and thereby it's in a defensive position whereby it would be a prompted disclosure. So it's far better to take the unprompted route and settle on a lower penalty rate, and probably on a lesser number of years, in all likelihood. And there we are.
Thank you, Paul, and thank you to Vicky. Yeah, that Spotlight 63 and that scheme is unbelievable when you look at the technical analysis or the lack of technical analysis from the implementer's point of view when you read through it. But yeah, it just shows the revenue are perhaps getting a bit more switched on in terms of picking up on these. I know there was a lot of press beforehand in terms of highlighting that particular arrangement and the people who were promoting it, and yeah, it shows where we are. Yeah, just got one question that's come in from Dee. Thank you, Dee. As no class 2 NIC is abolished, what will happen about state pension contributions? Now, this is an odd one in that whilst the announcement was that class 2 NICs have indeed been abolished, perversely, it is still possible to make voluntary contributions, and so anybody with any business with profits less than £6,725 can still make or would have to make voluntary class 2 NIC contributions in order to preserve their pension benefits. For profits above that level, then there's a deeming provision, which means that those credits arise. So yeah, bit of an odd one. Class 2 has been abolished, but a bit of an asterisk in the corner saying, except in certain circumstances. We've got no other questions coming in. So again, thank you for everybody for tuning in and listening. I hope you all found that useful and got something out of it. Thanks again to the presenters. Have a great Christmas, and we'll see you in the new year. What will it be? Around March time, probably after the budget in March. We'll have another one of these and see what comes out of that. Thank you.